Good afternoon, coming to you from Traders Community. It's January the 10th, and what a bounce. We actually got back to positive on NASDAQ as it was all def warmed up in the morning. We had quite a dramatic move, pretty much spot on to what we were expecting with a lot of it. We actually finished up positive, as I said, on NASDAQ, just a tad, but about 7 points after being down, nearly 3%, I think. Dow did finish down again for the fourth day in a row, and S&P, I think it's the fifth day in a row, but they did recover greatly. One thing to note on the S&P, it did not get back to the 50-day moving average, the daily, which is at, the weekly, which is 46.75. It closed around 46.70. Some would say close enough. The 10-year, which started off the selling in the bonds this morning, which started off the panic selling. It wasn't really panic, though. It was pretty orderly. Did get over 181% in yield. Remember, 180 was that level all the talk's about. That actually came all the way back and calmed down to finish at 177.20. 177%, which is just 1 basis point above Friday's settle. The 2-year rose 3 basis points to 0.9. Remember, that is the rate that the Federal Reserve rate is actually pretty well based on. So more and more there's expecting the raise in March. A few things happened. Once that peak was reached, that's when the dip buying started coming in, though it felt more like short covering. A lot of the perennial bulls that turned bearish in the last week or so were the people that were looking to sell that rally. So that was there, and then it started to move up. 8 of the 11 sectors closed lower today in the S&P. The industrials down 1.2%, materials down 1%. The health care sector advanced 1%. There was a lot of the Pfizer's and that group, the COVID group, were positive on booster talk. Pfizer was up, I think about 50 cents, right, Madavi? Moderna was up. Actually, Moderna was up 9% today. And the reason was upbeat sales forecast for COVID-19 vaccines. A lot of talk about new boosters, or I think Pfizer said that they have, I want to say they called it a hybrid, which covered the original COVID and the new one coming out in March. Other big stock news was Take-Two took over Zynga. The concern is they overpaid for it, or the dilution, because it is a cash and stock transaction. So Take-Two is down, closed down 13% for $21. Remember, a lot of people are in that because they got GTA and franchises like that, so they are worried it's diluted. Zynga closed up 40% this morning. When we talked about this, was up 54%. That's a cash and stock transaction for $12.7 billion after the market. Intel was up, I think it was like 12%, because the MU guys taking over there. That was the positive news there. There was no real data out. The only thing was wholesale inventories, which was up 1.4%, slightly up than 1.2%. Oil traded down today, down from its highs from yesterday. It closed under that November high we cited. Gold futures settled higher, $1.40 higher. The US dollar index was up. There's been a lot of talk. A lot of people were surprised that the Swiss franc was weak given the old safe haven deal. But we've seen a lot of unexpected moves. What one person thinks is safe haven, another doesn't. Personally, I think it's just because everyone gets the same way, you know. And what else did we see today before we look at the charts? Well, part of the big move up was what we call the Tina trade, which is, you probably remember that, I forget where it's from back in the day, from something else, from psychology, but it stands for there is no alternative, and the stock market or the analysts took that over a few years ago. And whether there is no alternative or not, the quants or the algorithms believe there isn't. Remember, they don't have emotion. They trade on what comes through their machines. And that's pretty well what we pick up on our Nova Wave through Murray and other mathematical-based things. The other thing was that the JP Morgan quant guru or quant maestro, Kolonovich, came out and said that it was overdone and he's looking to buy it. He said the same thing back in October when there was all the fear about yields, very similar to now. And I think it bounced like 12% from there. So there is that, whether that's coincidence or not. At the same time, his boss, Jamie Dimon, was saying he'd be surprised if there's only 4 rate hikes. I think a lot of people are realising, as we've been saying, that this was old news. It got built up as something new, and it's still very low interest rates. The velocity of it is one thing discussed, but it's whether the banks will actually lend the money, whatever the rate is what's relevant. So we'll see what comes out as far as that goes. Let's go ahead and look at the charts now. So the S&P, we have the daily here on screen. Just give me one sec. So we have the daily on screen here. And there we go. I just share that for you. Sorry, Madabi. I keep forgetting we put this on one of the new computers. So we can see that we got under that tanking, and as we know, that's our big deal. We talked about this morning, our target was this channel and the cloud and that unison point, confluence point where we got. I've left it wider here because I want to show you something else we saw too. We had a very healthy bounce, nice wick. Look at these, very similar. And we closed over the Cajun, but under the Tankin, and also under the 50 down here. So this is Expo, that's simple. So we closed just underneath that. What I want you to look at down here is one big thing I look at is divergence, and that works in with the Murray. So we went, look what we did here as far as the volumes go. So we can see that this wasn't a heavy volume sell-off as opposed to the other ones. And we actually, this one we did have positive divergence though, meaning this high is higher than this low, and this volume is higher here versus that. So you can see that divergent. On this one, we have much higher volume on this and the opposite here. So we didn't get the volume sell-off. It would have actually been more positive if this was higher than that, but you can look at that another way as far as that goes. Okay, let's look at the 60-minute. More noticeable here. And let's widen this up for you. So you can see what we did. We got right in, just underneath minus 2/8. We got the overselling here, the Chicow, and with this wick here, and then we got the reversal when we came back through and failed to follow through here. So the old 1-2 AB, this is hourly. We accelerated, but we look at, remember, it's important to put all these together. And you have your game plan ahead of you already, what's going to happen. And we closed sharply up through both of these. sharply up through here, just short of the 50. But nice power move right in the close. As I said, we didn't quite get the daily, but we're coming in to meet the cloud here. We have a measured move of almost 4. Actually, we do have the perfect measured move there. So we have achieved that very nicely. We're in 1, 2, 3. So basically it comes down to whether this is 1, 2, 3, 4, 5 of a first wave down. This is forming a 2 to go a lot lower. Or this is your ABC. If we go back to the daily, that'll make more sense. Correcting this whole move. And if we go to the weekly, you can see even more concise, right? And look at that. We closed above the weekly Tenkan. So we are in good shape as far as that goes for the bulls. And there we are of our same channel. So there's things there that for the end of the world that's going on, as if you listen to, as I said, the media, the FinTwit spurts, and all the dribblers out there, then we're going to zero. But keep it very disciplined and look what happened. So anything can happen after whatever Powell says tomorrow, but know your levels and respect both sides. Okay, let's talk NASDAQ. So this is Madavi's baby. So let's bring on the, where's our NASDAQ chart here? Here we go. So here's our NASDAQ weekly. Didn't quite get the same level as far as this channel goes. We did have this spit up here. So to be a perfect fractal, it would have been nice to go under this, to call an end to this. So it's a bit premature to call an end to this just now. But very close. If we get through this, the cloud beckons below. And then we have, we can see again where we closed just above the Cajun, but under the Tenkan. And let's have a look at this on an hourly basis. Okay, do you want to talk us through this one, Madavi?
Yeah. Well, today, it's kind of, I picked the direction that I thought it was going to go, and I stayed a little bullheaded, thinking we were going to make a move after big moves, and it really didn't work out for me too well. And that's the importance of not having your mind completely set on something. So I was playing catch up, and then for the close, I thought we were going to pull back a little bit, which we basically covered a whole gap, went straight up. I was kind of off today, wasn't and I didn't want to, for some reason, I didn't want to change my direction. So I paid the price for it. So that should be a lane lesson for everybody. You can never, sometimes you could take a direction, and a lot of times it'll work. But on days like this, it might not work good for you. Even for a guy who's been trading as long as I have, so I take the good with the bad, learn from it, and move on. I knew there was a possibility this could happen. I mean, we did me and mate called it up when it was selling off. We thought it was going to bounce, but then
we did get the bounce. So I trade, mainly SPX. Yeah,
I just paid a little more, and it was just like, I thought I was going to go the other way on me, and I was going to lose what I had. And, after being in that position so long, just got harder and harder to get out. That's why it's sometimes good to take your losers sooner.
Right, definitely. I think what the difference between you and I today was basically I traded the spoos, and NASDAQ was the one that kind of took off a little bit here. So if we compare that to the spoos, where's the spoos?
Yeah.
So while this was directional, it traded very clinical for me, and I was able to pretty well stay long. I got out a little bit here. Mainly, I kept call. I actually played some Apple today, and we'll look at that in a bit. But what makes it hard if you're trading... So futures, you don't have the problem of vol. If you trade options, you've got to make the decision. You may be right long, right? But as you go up, vol will get crushed, which is what happened. So yes, you can sell vol by doing a spread or depending on your game plan, selling puts. But if you're just a straight out directional trader, so in those situations, it's going to be better or more efficient to either trade the future directly, trade the stock. It all depends on capital allocation. Or, so you look at where your vol crunch is going to happen more. So this can be a bit different for people. People look at the volatility of that, yes. But then and it depends on your capital. It may be better to buy something more out of the money than in the money. You obviously can expose yourself to more, but you're not going to get hurt as much by vol as it approaches it. That's a whole lesson in itself. But that was pretty clear to me on SPX. But like Madavi said on NASDAQ, if you remember, mate, you made really good money on Russell today. Whereas I was like, I'm not going to touch that, because on Friday, there's a couple of times it was good, and then remember that it reversed on us, or not on you, but on me. So I missed that trade. You did a really nice trade there, actually. And looking at the Russell, so it depends what you look at. If I hadn't looked at the weekly, it was a gift to buy. Look at this, 1, 2, 3, 4, 5, 7. Is that true? Like 8 bounces. It was off the 50 and bounced up nicely. However, though, I was watching this thing, the short one. And so when I was buying the Spurs, and we bought the Spurs together, I think, and then the NASDAQ, this thing kept going down, remember? I was like, I'm not touching that. So that's not a bad thing as risk, but I did miss out that opportunity, because that was actually probably the biggest percent bounce, because that actually came all the way back to basically be flat. I think it was probably flat just before settle. But as I said, it is hard when sometimes you're on a really good run too. You tend to, the market can be, and that's the thing. The whole thing is trading is a mental thing. And actually we got later on, once we get more set on all this, we're going to be doing a bunch of interviews and stuff with successful athletes and, mental toughness and all that. So that's kind of exciting once we get more used to this podcast thing, right, mate? But so a lot of familiar names you'll know and things. But so the point being about mental.
We did that Intel trade. That's the only stock I really trade after market, and didn't do much stock during the day.
No, it was really a good futures and options day. Yeah, Intel was a nice one, wasn't it? That was... it
was up almost 10%.
Remind me what that was again, the guy from MU?
They took MUs.
That's right. And so my assumption also on that would be that there's a lot of shorts out there on Intel, I would think. Because it was one of the most beaten down stocks, NASDAQ got drilled. So people tend to go like heavy short sellers or longs that have been hoping for a bounce, usually tend to give up. So that probably helped fuel that rally as well. Here's Apple, which was just a beautiful trade, I thought, today. It got down here to 08. It took a while to get going. And remember, I did it via optionality. So what I found was the good buy here. Remember what I was saying about, I believed if I was right. So here's the thing is, if you're right, you're going to lose on vol, the vol component of your structure. So you want to get, a lot of this comes with experience, but you want to get to a level that you can benefit on, that you're not going to lose too much vol. If you're wrong, vol will pick up. Yes, you're going to lose on your pricing, but at least you're going to be limited to if that makes sense. That's on a thick option, something like Apple or Spider. On something like IWM or Russell, it doesn't quite work like that, as we were talking about from Friday. But that was a nice trade. Very, very easy. Here was the easy profit on that 50, and it came down. Vol came off. So actually the option that you sold here was actually still worth more even on this, because vol came off for that second one. See that red wick. So I think that's all. Anything else on stock? Should we just look at oil and gas now, I think?
Yeah, I mean, besides the future, there's everywhere. So yeah, gold, oil, and gas.
Let's
It
have a
was
look.
crazy.
Actually, a good comment here from Sarah. Thanks for joining in, Sarah. Sarah says, I sat on my hand till I saw vol drop. Then I knew a big short covering on was order in SES and NQ. And that's another point. If you're watching your vol, and you particularly if you got positive divergence, it's a really good sign for a market move ahead on the upside, and vice versa the other side. But yeah, and basically a good point, the vol was too high for the month on term structure. So look at that another way. If you own puts, and we've talked about this before, when something gets really sold off, even if you're right, you can still be wrong because the vol's too high, right? So that's another thing with that. Just to look at gold real quickly. So gold, I don't trade a lot of gold. Madavi trades a lot more gold than me.
Yeah, mostly buy the metal.
Yeah. So you're more as part of a longer term play there. But what I'm really interesting is, look at this triangle that's jamming in. This is on a weekly. And we mentioned earlier that the Swiss franc was weak today, which is a typical, what's the word? Preservation trade, safety trade. Gold itself today was pretty well flat, right? But look at this. If I've marked this correct, so it's 5 of 5 means this is ABC, it means this is a major high. But if this was just the one of a much bigger move, which is more what you're thinking, right, mate? Then this whole move here becomes an A or 1 or 2, and then if we break, so in other words, it may take a while more, like it could be a few months yet, but this is due for a very big move one way or the other on gold. So don't just assume it's all done or it's just going to fly. But when it does happen, this does look like it can move something. And if you look at copper, copper's just been going, these are weekly charts, copper's just going sideways. The relevance of these is copper is obviously a big commodity that has a lot of geopolitical factors, not because of war, mainly because the countries where it's mined aren't the most stable. But we need this in infrastructure, but also obviously in alternatives. As far as other commodities, let's have a look. Corn, broken up. These are the same ones we have in our weekly. Soybeans, looks like an ABC. We are in the middle of correcting. It's in the middle of a cloud. So a lot of these look a little bit overdone. And do we have silver here? What's silver? XAG, right? So silver it's lost its shine compared to gold. Look at that. Isn't that what they call poor man's gold? Isn't it silver?
Silver, yeah. Or copper.
Yeah. At least you can,
Going up a little bit.
Which one?
Futures.
Let me have a quick look at that before we look at oil and gas. Where are we? There we are. Oh, yeah. Just a tad there. This is an hourly chart. I should speed it up. But let's go to energy. So we're going to look at oil on the short term before we go long term, because I think we're all pretty familiar what's been going on there, right? We're broken back up daily. This was the Biden gift to the world down here when he sold out of SPR. Exxon bought the majority of that, by the way. So do you think they're unhappy? So we're up from that level. This was it there? No, it was here, wasn't it? Well, we'll look at it in short term, I remember. But anyway, what we're doing on the 240. So yesterday being Friday's market, we broke over this high. There's a lot of talk about this high, the November high. We broke over it. And this week we came under it, but we did a lot of work around it. So it's not. So we are under it, but look what we've done. We've done a lot of work here. So this is the November. When we go to daily, you'll see what I'm talking about here. So what we need to do, we're watching on the 240, what we do when the Cajun and the Tenkan come together here. From a fundamental view, we had a big, the EIA, remember, it was the end of the year. We have all that taxation effect. Basically, you get your drums down, you produce a bunch of oil, and now we're coming into the new week. This next week's EIA, or this week, will be last week's. We'll see what that does. We also have what's going on in Kazakhstan, and Libya is hardly stable. We have the really cold weather in Canada and the northeast of the United States. So that's your fundamental structure. It is affected by risk on and risk off as well. So we look at daily on this. That's the level we're talking about, right? So you can see it more clearly there that we broke over. So if you look at 240, that clouds around where this daily is. Look where we are on Murray. So minus 5/8 to 8/8, a full move. That's what we're retesting right here. So remember, this is all math. So that keeps your mind at ease. Yeah, good point, mate. Sometimes the best trades are the ones you don't do. So if we look at our weekly, 1, 2, 3. So that's why I've labelled these 3 or a 5 or an A or 4, because we don't really know if this is still a B to a C or this is a 4 complete. I mean, there is also the more bearish outcome where that's a total 5, 1, 2, 3, 4, 5 down here somewhere. Doubtful. You never know in this world, and with the politics going on and all the shocking leadership around the world. I mean, but look what we stopped at was that old 61.8 that we spat over here. That was the high, right, of 2 weeks ago, of last week. Okay, let's move on to Natty. Natty was just a thing of beauty today. It did that classic. We talked about selling the gap. And I'll look at the 240 in a sec. But we gapped above the Cajun here. Look at that. We didn't quite get the 50. And we closed right into the middle of the bar. So for those that are old school, remember what that is. So that basically means what do you call it? I'm trying to think what we call that. I forget my candlestick names. But what we did perfectly was come back to rebalance here at the cheek hour right there. And we have that labelled the same until proven otherwise. If we look at it, and remember this is just up because of the freezing weather, and we broke out of that range. Anything more than this would be if optionality gets out of whack. For those that are old school with Natty, here you can see a bit clearer. The 50's your support, Tenkan's your resistance. It's a C or a 3, pretty straightforward, yeah. And if we look at let me see if we can show what I'm talking about on the gap. So here's an hourly. Remember I said trade the gap this morning? This is just classic stuff. It doesn't always work out this, but it's a bit of a gift from the big fella, as we say. Plus 2.8. It's sold into the gap. And look at that. Filled the bloody gap. Isn't that unbelievable, mate?
Yep.
I mean, that's just unreal. I mean, it just shows you how the machines work. And also it becomes self-fulfilling. And when it filled that gap, boom, straight back up. And we closed back and tested 1/8. So this is a violent commodity if you're not used to it. I kind of shut it. So here, for example, this is all on weather. It was kind of predictable, this one, because it was freezing. We had threats of that cyclone bomb and all that. But that's a good example of clinical maths. And people that don't like algorithms, the reason this happens so fast is because of algorithms. So if you're using a system that is more than likely what they're using, that's how you're going to be benefited. Crypto. So here was Bitcoin today. And this was This has been just classic technical. I mean, it's not, I'm not a fan of things that can move 20% against you on a weekend. So I don't actually trade this. I do the odd play around it on stocks and stuff. But look at what we did today. Classic. We got into the channel. We hit our exact target, the crevice, on the cloud that we talked about this morning. Hopefully you guys listened to the wake up there. And we spat the 50, and look where we closed right on it. That's a weekly chart. I don't think we need to look at the more short-term ones, but that's it, and that's a classic thing. Do I hear Johnny there?
Yes.
Yeah.
Okay.
So here's Johnny had some good points on Bitcoin he was talking about before, whereas I tend to look at this as just another risk asset. So when Nadsaq selling off and all that, but he had some good points about the whales and those guys, how they handled that, and it looks like do you want to go ahead with that?
Well, you've got a number of people who have large stakes, as I had mentioned in our last broadcast. What was it? I think it was Binance had a 47,000 wallet transaction of Bitcoins that came through. So that's a pretty large $1 billion transaction that it's now holding. So there still seems, so there's a lot of things happening with the kind of formation of what the value of Bitcoin will be. But there's also a lot of other things that are happening too. I mean, you've got, if you thought about it, not much more they could have as headwinds with regulations by, legacy banks and the central banks, sell-offs due to fear, end of the year, tax planning, things like that.
I didn't and then you've got tax if you traded Bitcoin. Did I miss something?
People selling off so they could, due to fear, and then end of the year they want to taxes. They maybe sell off their Bitcoin or whatever it might be to have the money to pay.
Yeah, I got you.
To get the deduction, end of the year tax planning, just the different things like that. But the environmental issues also, they've been under attack for the amount of energy that's gone into the mining of it all. And, China shut that whole thing down, and that gave an opportunity to, especially the United States, where we have a lot of big miners here, like Marathon and Riot. But there's other parts of the world that mine too. And just recently, Kazakhstan. They actually, I put it in the room for you.
Yeah, they got a few issues with coppers getting their
they're cracking down on it too. There's different governments that are cracking down.
They got that war going on, the internal civil war that, remember, so... Yeah, so we'll see what happens. So here's the interesting thing with Kazakhstan while we're talking about it. They're the second biggest uranium miner in the world. But
you look in the room. I did put something in there. They're trying to ban the.
You're talking about Kosovo,
mining.
I think. You're talking about Kosovo, not Kazakhstan. Kosovo is the one that wants to ban it because they can't afford energy. Is that what you're talking about?
Here, we'll go to the crypto room, and you'll see it's got a little thing.
I know Kosovo
Kazakhstan. It says Kazakhstan crackdown hits crypto miners. So what's happened is that because there's been a lot of miners and stuff that come under these federal and regulatory issues, hash rates start slowing down the transaction and the ability for people to do what they want to do with Bitcoin.
Okay, I got you. Yeah, I remember that article now. So they had 18% of the global hash rate.
Yeah. So all these things are facing Bitcoin at a very bad time, and I think both markets, the equities markets, are kind of going through a lot of, adjustments because we've got circumstances with QE and all these other things happening. Got the same thing. Bitcoin has really mirrored what's going on with the equities markets, but there's sometimes changes that are contrasting one another, where people may move their money from one place to the other. But I think it's all kind of early adoption. And you just have to be mindful that there's a huge risk right now because of all these forces.
Right,
And,
right.
you know,
Yeah, so I just reading that there. So Kosovo was the one last week. That's a small country, as we all know, and created. And, well, how long ago was that independent? But it's fairly recent. But anyway, with them, it's a lot to do with the energy crisis going on in Europe. But if people aren't mining, help me out here, that means shouldn't there be less Bitcoin available? So that shouldn't that be a positive thing for Bitcoin? Or am I misunderstanding?
No, because every time you do a transaction, it will slow down if there's not enough people, right? So you don't want to.
So you want as much mining as possible.
it's like having
Okay.
AOL do your dial-ups internet. You're trying to
Well, what do you
stream.
mean? That's what we're doing right now.
I mean, it's like trying to trade stocks on the dial-up, or waiting, or like before I used to send in the market maker would have 10 seconds where you had to cancel it when you throw out the orders.
Well, remember way back in the day, load
Yeah,
to
that
buy,
was way
load
back
to
in the
sell.
day.
Remember all
Those
that?
days.
Sorry, audience, we digressed.
Yeah,
But
yeah,
the
we
thing
kind of
is
digressed.
it has an effect.
When I first started trading, we'd spray a bunch of orders because it was just like a market buys and sells, and then you start hurry up having to hit cancel because you knew if you got filled, all of them, you
Yeah,
were
yeah,
wrong.
yeah, yeah.
Market makers had 10 seconds to decide if they want to give you stock or not. As soon as you didn't get any fills, you knew it was a good position.
Right. I remember that.
Yeah, and that was one of the big things at the beginning, mate, when this whole Bitcoin thing came and was conceptualized as a replacement for the banks is speed of transactions. And they've come up with a lot of technology, but it still really remains, since it's proof of work on
the
those
speed
miners.
isn't there yet, yeah.
Yeah, but the speed has improved. But when you start regulating and countries like China completely outlaw it, and then it goes to other places, and they slowly start regulating it too because of energy.
Yeah,
It's
it's
gonna
mainly
have
because
its-
of energy. That will improve, though. Whether it's good or bad. Unfortunately, by not planning the transition into more renewables, and the way they did it was just stupid populist politics. And
Well, this is my opinion. What China did.
we'll see, but that'll simple out.
And get all the infrastructure set up on their dime, and then ban it and tell everybody, hey, you guys still want to mine? Why don't you do ours?
Right, and I can see something like that happening, or even, and it may not be Bitcoin, it may be an alternative, but obviously,
Just think of Ethereum.
Yeah,
Ethereum
right.
was
Ethereum's
built
just
on
so
proof of work,
expensive,
and now they're
right?
doing proof of stake. So
Right.
their merge that they're going through is to get on Ethereum 2.0, and that's where proof of stake
You know what?
it's less
I'm
energy and
interested.
faster.
So on Friday, JP Morgan are reporting earnings. So if you remember last earnings report, Jamie Dimon, Madavi's favourite banker, I might add, he started to talk about more. He was famous for saying Bitcoin was rubbish at like $2,000 or something. But since then, they've moved on with it. A lot of the banks are using blockchain in their accounting systems and stuff like that. But he's starting to more and more. They created a fund, if you remember, maybe 6 months ago, investing in crypto. Not specifically I think a little bit in Bitcoin and that, but in the stocks, like MicroStrategy, etc. I'd be interested what he says on his earnings report, I think. Because it's a good time to mention it, right, with the Fed and everything.
Well, you've got that, and all the banks and financial institutions are having to look at it and really study it, because if they don't, like, the evolution of innovation and man is always to do it bigger, better, less money, and less, and less data or whatever you want to call it.
Well, the main thing with the banks, they want to be the first guy, right? Or at least get in control of it. So really the competition is Goldman, JP Morgan, and Morgan Stanley pretty well, right? But let's look at this chart I wanted to look at. So this is Bitcoin. This is an hourly chart. So this is each day it got down here. Then today, or is this the 10th? So that's today. So look at this trap. This is an hourly chart. I'm going to go a little bit short term to see it. But look how that went down, guys. Collapsed to 39, looks like 39,600. Does it tell me the low? Let me look up here. Right there. So, and look how quickly we got about. There's got to be a lot of people Johnny trapped down here, short, or at least not just short as in short the thing. It was on futures, like the Bitcoin futures, but a lot of Bitcoin people just like to trade long, don't they?
Well, I think that there's something else playing out, and that's the big whales want to see it go below that point, because once it hits there, it hits 30, and then the whole thing starts falling apart.
Why do they want it to fall apart if they own it?
They don't. That's what I'm saying. They want to keep it above the threshold where it will start
so showing. It could be. So it's very thin. So here's that on 5 minutes. So here's the collapse. This is 5 minute bars. So this 5 minutes, it's gone from 39.5 to 41,200 in 12 minutes. And then you can see averaging went on, and then it ripped all the way up to 42. This is one volatile beast. Look at this. These are $1,000, $2,000. Anyway, the relevance is if this holds, which it can do. Remember, we looked at that weekly chart, that weekly cloud and everything. It has achieved a target that's suitable to have been a hold. So I know everyone thinks out there, CNBC, the FinTwit dribblers, that the top is in for the whole market. The same people, I might add, that were buying it. But this is I like to look at this as a speculative end of the market. You know what I mean? And look at this reversal. That's powerful. And it came back into the medium and took off again. And we're basically, if you take this wick out, we're trading right up near the day's high, right? This is this is Bitcoin. It can do anything. But that's an interesting fact right there, I think. And if we go to 4X, where's our 4X? Here. Maybe it's this one. So, so let's compare what happened with Bitcoin today with, say, dollar yen. So this is a 240. So when Bitcoin reversed, look what happened to the dollar yen. Almost the same time, right? So this would be Bitcoin falling. They were buying dollars. When Bitcoin rallied, they bought yen. Do you see that? Can't be unrelated. Because remember, we're looking at Bitcoin as a transaction vehicle now, right? So if Bitcoin goes up, they're also effectively selling dollars, correct? So buying yen. If you look at euro, that's a 5 minute chart. So I was doing some other stuff on it. But you can see the similar moves, right? That's a 10 minute
I kind of
chart.
think for just a moment sometimes that, it's a world financial market. All these things are connected.
That's what I'm trying to show here, yeah. So euro, Bitcoin, same move. Yen, same move. Aussie, same move. So they're not unrelated like everyone thinks. I just think it's not everyone. We obviously don't, but
it's like the great Madavi said, money has to go somewhere.
Yeah.
Would you elaborate on that, Madavi?
The great Madavi. He's never going to stop.
Money always goes.
That got him up.
I mean, money just it flows to certain sectors or whatever. Depending on the market moves.
Right. And so it's the power of money. And so people have become so inability to think for themselves. So they're always following. So the bottom line is here, 2 or 3 months ago, it was obvious not to be in certain stocks. I mean, yes, we tend to go out too early. We tend to not chase the dribblers stocks anyway. But it kind of drives me. What did Brian always say? It grinds my wheels when people who should have been telling people to sell stocks at $400 are telling people to sell them at $150. Yes, they may go lower. It's not the point. And a lot of me takes, and I look at who says what. A lot of me think people are blaming Powell or the Fed. to hide their own fallibilities that they think. They are fallible, they are wrong, but that's all part of trading, admitting when you're wrong, being able to do contrarian. That's why we look at Murray and everything else. But I see a lot of this. So I just wanted to bring up the French market has been the best one in the second half of the year in Europe, and it reversed the last 2 days. So here's your all-time new high. But look where it was. Remember we were talking today, Johnny? Almost plus 4.8. So you know it's extended. But what happens is the fear of missing out gets you to, I got to buy this, I got to buy this. So what you're doing is increasing your risk more. I mean, we can go through every market like that, but I think we pretty well covered everything, haven't we? We covered everything. So let's look at NVIDIA. That was another one I wanted to look at. So
I was actually playing that just before I got on with you.
Oh, really? So here's the
Yeah,
weekly.
the thing is, it's a monster because it can go down to almost 250, and then out of thin air, it's up to 275. If you
right, so there's this double bottom here. This is a weekly at around 270. It gets under that, you got the Cajun underneath at 260. But look at how this one in Murray, it's really beautiful. It goes from here, the break. So I think here, when did they do the split? Was it 4 for 1 or 5 for 1? I think that fed this one. So 200 to 340. That sounds about right.
Four split.
It was 4 to 1, right? So
yeah.
That fed this. It goes to plus 3.8, off 1.8. So you got your full move. Then we've come down, and this is a hard thing on these sort of stocks on weeklies. If you just use one thing like Cajun or just, but you want to be trading at the money. That's why the people that get wrecked, I think, are people that use these latent things like crossovers, MACDs, all these things. You want to trade at the market. But look at that. Now, if we go what you're talking about, hourly on NVIDIA. So watch as that develops. Look at the moves on these. See how that's moving? That's pretty cool, I think. But, so we want to look at today and yesterday. So this is what you're talking about. So today, this got down to 256, and now we're 274. That's what you're talking about right now. And look
the day
what
before
that got down to.
The trading times, the periods, 2 or 3 days of trading time.
In 1 second.
It was up to 300. It went down to 260.
So yeah, if we get, this is an hourly chart. So the 28th, we're at 314.48. Here we are 12 days later at 256. They got minus 3.8. That's how much it was oversold, right? That's a full move. And then, but what's good, this bounced, and it gave us, also helped us confirm that Apple trade we did, remember? So this is kind of Apple on drugs, but look at that move, and that's a $20 move there. Now, if you're buying, if we want to talk options on this, you got a bigger spread, and a vol's going to collapse as this moves. So that's a difficult one to trade if you're just a straight out options buyer. You really got to have a that plays better to have a spread. But yeah, that's a nice one. And if we want, let's look at the SMH, which this is the weekly, which is the chips. Let's have a look at an hourly on that too. So the chips, obviously, NVIDIA's the darling of that. That's going to be interesting tomorrow, Madavi, because of Intel. That's going to affect that whole chip just because they're weighted in that basin. But look what the SMH did.
I think they're going to sell the news off. You know how there's buy the rumor, sell the news. Until it started coming back down, if you look at it.
Right, individually. But what I mean is it's a big component of the SOX and the SMHs and things. Be interesting how much it influences.
But by that time tomorrow, it should sell off back down.
Right. So he's looking at the SOX here. See the bottom
surprises
here?
you.
Huh?
Nothing surprises me. It's this run up
Well, that's an
tomorrow, and then
important thing to learn in markets. You learn something new every day, right? So look at this double bottom. That's one of the old school things. And we saw that on the Russell. But this is classic Elliott wave. Plus 1/8, ABC, so 1, 2, 3. Then we get, so that's your A, then your B, look at that. Then 1, 2, 3 long waves. So this can be an ABC, i.e. 3 waves. But what you want to see is, if it is, we need to get powerful impulse up here to get into the second wave, to make this something to go higher. If not, this is building a 5 to go lower. Just keep it that simple if you do those sort of things, Elliott and all that. I think the last thing we wanted to do was look at tilt, which is yields. So this is a daily here. You can see what's happened today. We're back. And so, what was the guy's name? Kowalski from, what is his name again? From JP Morgan. Kalanovic. So, right here was when he said it was overdone on yields. He said the same thing today. And that came out, I don't think the stock market reacted to it. I didn't see it mentioned too many places. I just happened to know the bloke, follow it. If this is the case at tilt, then if this all holds here and we go back to lower interest rates, i.e. higher bonds, remember this is inverse, that gets pretty interesting, right? Because this has more volume than these sell-offs. So that's the tilt, the TLT. I think, and the other one we were looking at, VIX, and we'll finish up looking at everyone's favourite, Kathy. So this is the VIX. We got to really look at this at an hourly basis. So if you trade options or you trade futures, you really should understand how volatility works. Now, VIX is not what it used to be. It used to be much better. Now it's its own futures contract. So that distorts these moves. But basically the concept's fine. So this is the VXX, which you trade, right, Madame? So this is what we've done today. Look at this panic. Panic, blah, blah, blah. What's interesting, we opened high and we sold off all day. Remember I was talking about that with buying optionality. So that's where you do your spreads, or you look to what strike you're going to buy. But that was a big sell-off in vol today. Look at that. Which also shows you, it should show you. So back in the day, if you saw these sort of moves 7 or 8 years ago, it would be more meaningful and people use it as a hedge. Now, we are obviously nowhere near the height of where the market was here on the 5th. Yet look at how quickly. So if you're using this as a hedge and you're holding on to this to protect your stock, not a good idea. Trade it individually.
That's a good idea to use those as a hedge, right?
So, I mean, you see people do that, and then that's where they get lit up on them. Here's Mayhem come in to join us.
Everyone.
He's a busy man these days, old Mayhem.
There's so much mayhem in the markets, I'm spreading myself thin.
Well, I didn't want to talk about your hairstyle. You brought that up. But let's look quickly at Johnny's favourite. So this is everyone's favourite, Kathy, right? So this has been one of the easier trades I've ever seen, actually. We got pretty bearish this a long time ago. We're almost at the 61.8. This is the K, right? K, remind me what K is again? That's the innovation or the main tech one? Innovation.
It's the main innovation one, yeah.
So this is actually getting where there is actually finally getting a reason to buy, but potentially. I'm not going to buy it, I'll give you the tip, but if you're so inclined, it comes in here. Was this little low back in August, and this is when everyone fell in love with Kathy, right? So this isn't really her fault. This is when ETFs. So when she buys it, when someone buys it, she's got to buy it and load up on it, and then it became a self-fulfilling disaster once it fell. They're all really thin stocks and big spreads, and she just made some bad choices. Should we talk about Hood or should we talk about...
about the G.
Right. Well, we're going to look at G in a minute, right? Because that's your favorite. But we didn't...
There's a reason why.
Many G's were lost in ARK G.
Right. I have my... See what I call it? Ark of the Covenant is not as it appears. So they're still looking for that Ark of the Covenant.
Nate, are you saying that perchance ARK has sprung a leak?
It sprung... I think it's run ashore. And I think it's got what's his name? Who's that comedian? And it's not Russell Crowe playing Moses. It's what's his name from The Office? Remember he played Moses too?
Oh yeah, Cottrell.
Yeah, I think it's for him. Yeah. So here's ARK G. So if we looked at, so we just look at ARK K again. Look at the double bottom. It's not even there, right? And it's also, what's intriguing, that double bottom is also 61.8. So if you want to talk about machines and people being predictable, but look at ARK G, it didn't even bother. It's just straight through it, right?
Only reason I'm in ARK G is because with COVID and all with all this innovation that she's hyped on, it really is playing out in a lot of the devices, the therapeutics, and even Alex can chime in because he's into the whole bio, pharmaceutical industry. The opportunity is going to be there with gene editing and all these things. Now they may be a little bit down the road, but there's more and more of that played on, and there's companies like CRISPR, there's other that are just
I mean, I agree.
Regeneron.
I agree they're on on her innovation, all that, but there still has to be a value on what you pay for it. Look, I trade oil and gas mainly, as we all know, but I'm not buying. So there's a time to buy and sell oil and gas. There's a time to buy and sell oil and gas stocks, profitability, the market, and things like that. The same thing here, except you're paying. The trouble is with. So okay, let's just talk oil and gas companies. If I'm an exploration oil and gas company and I'm trying to, I'm fracking, trying to find it, I have a higher cost of entry, right? Therefore, I'm like, if the price comes down, my stock price is going to fall. Of oil or gas, and then I have to go to market. This is assuming we don't have the ESG. No banks will allowed to lend and all that sort of stuff. Just say in a normal world. So that burn rate's pretty high. In things like innovation, firstly, tech's a little bit different. What I've noticed with tech, particularly IPOs, they tend to burn through all their money because they overpay. Their technology people usually own the stock. We see a similar thing in biotech. The other thing in biotech, you actually have a really high expense rate. The smart guys were doing their secondaries when the ARK G was up here, but she couldn't do that, right? She invested in these people. So when they did a secondary, and this is ARK G, right? So a lot of these, their stocks just got killed because they're doing secondary, but she wasn't getting the benefit of the money. Does that make sense, what I'm trying to say?
It's also
it was a way for a guy like me to get exposure to it without
you don't have
the
to
individual risk.
Well, you can get COVID. I know you've already done that. Sorry, you got to.
Twice. But the thing is getting exposure to something. You can get it in a basket, or you could get it individually. And either way, it seems to be less risky for an amateur, novice, beginner, whatever you want to call it. Just like with oil and gas, if I went in, I'd get my butt handed to me because I wouldn't know the nuances that you know. I'd probably want to get into some kind of fund or safe investment vehicle that would give me exposure, hopefully upside, not complete downside like the ARK funds have done.
Oh, Johnny, just come with me. I'm no Hall of Fame over there. I got a negative 36 on oil.
Oh, here we go again.
So one of the things that's really important to talk about when it comes to ARK and all the ARK funds is the position concentration, the amount of ownership they have of some of these companies and how it's not just from ARK alone. It's actually from, they have other funds that mirror their holdings too. They in particular have surrogates in Japan that mirror their holdings in similar sizes to what they have in the US. It's about half the position size. So like the top holding of ARKG is Teladoc, and the top holder of Teladoc is ARK. And ARK owns something like 17% of the shares. No, I'm sorry, 19% of the shares outright. And then through their Japanese surrogates, they own another 9.5%. So you're talking about them owning over.
Wow.
Yeah, exactly. And that's a repeatable thing. Like when you look at some of these other companies, so that's the number one. The number two holding is EXAS, that's Exact Sciences. And ARK owns a huge amount of this company too. They own at least, with all the surrogates factored in, at least 15%. And it just goes down the list like that. So the problem that you hinted at earlier, where liquidity starts to come out and ETF units are destroyed and they have to sell, it creates a sort of a feedback loop in some of these more concentrated holdings, which also happen to be more liquidity sensitive, more negatively correlated to rates. So I think it's really important, when you're looking at these funds or their individual, like if you're buying something and ARK's the biggest holder of it, you got to worry about that as an exogenous risk factor too. Like what happens if ARK's holders start dumping their shares and ARK has to keep selling the company you're in? So this is something that others have talked about as sort of like the risk of ARK becoming this sort of feedback loop of selling. And I think it is a real risk in this type of environment where you have tightening liquidity, rising rates, you have folks that are changing their risk profile. That's not to say that these things can't have a bounce here. They may indeed, especially if rates start to come off. But ultimately, as we get later cycle into sort of the expansion phase here, this sort of stuff comes out of favor unless, as Mate aptly said, unless it's really making money. Because if they have to dilute their shareholders and they have to borrow at ever increasing costs, that's going to put a lot of pressure on that risk premium.
Right, and remember, they're not like to them. Okay, so I made a comment earlier, like interest rates really aren't going up too much, which they're not. The reason it creates fear is, and I think Alex referred to earlier in one of his podcasts, is about the velocity of money. So that's the speed of it. I think even more is how do we say it? So a bank's already reluctant to lend really since 2008. And particularly when moral hazard went out the window. So if they've got any excuse not to lend, so that marginal rate that we're talking about, that velocity then gets extrapolated in a really negative way, or a positive way as far as the yield goes, but a negative way for the lender. So if I'm one of those companies that ARKG's got that Alex was talking about that needs money, that now rates are higher, even though marginally, just say they only raise 0.25%, right? 2 rates, whatever. That then gets extrapolated to they want more of it. They might want an equity stake as well as lend them money, which dilutes someone like ARKG even more, right? Remember, they don't get the benefit. They may not, there's all these sorts of things. And so I'm not a fan at all of having, of people with things like putting money in ETFs, having someone else manage them. I've been down that road years ago. And I could tell some stories, and none of them are good.
One of the things I wanted to mention, though, is that some of these companies that are in her portfolio, though, they're forming relationships with, say, Bristol Myers Squibb or one of these, big pharma companies that want to get in because the innovation of these companies, and so they help throw $50 million at it or $2 billion. And there's a lot of examples, like even Veritex, one of our holdings. And, let's use one of those companies in. So on BMY, I bought into you. Just assume this chart we're looking at is one of these companies. So I bought in you at 108. ARKG's hot. I got it, whatever the part of it was. Now we're at 51. We've moved on. I've spent, how long is that, guys? That's a full year, right? So I burnt through a truckload of cash. BMY goes, you know what? We're not real happy. They want to do a second round. They go, okay, but we want these shares at a much heavier discount, or we will lend them in some preferential conversion, something like that, right? So as me or you being an investor,
I'm now looking at $48 for my 108. BMY, they got a bigger chunk, and if it works, then they're probably going to move to take it over at a much lower price or do some royalty distribution, something like that. If it doesn't, they walk away, and what happens to that stock? See what I mean? So there's all those risks that are built into things, which is what, Alex, I think you were talking about, mate, when you were saying that there's that risk when you buy. So people, in this run up here, people were buying these stocks because she was buying it. Now they're finding out not only are the people that bought ARCG maybe having to get out for margin calls or their investment advisors dumping them or whatever. If I'm buying this stock here, it may even be more pronounced that it falls. That stock, in other words, those stocks may actually be down more than what this is, ARCG, you know. That's the risk there. I'm being a bit of a Debbie Downer.
Add on, I think one other thing that's really important is that a lot of this market's driven by options. Like there was 50% more volume in options than shares, or something like 15 to 20% more premium paid. And that's really important when we're looking at this kind of stuff, because
that's on RG, you mean, right?
No, I mean the whole
individual
market.
Stocks
The whole market, yeah. Like the whole equity market, there was so much more volume in options than equities. And that is in no small part in all this stuff that's favored by retail, all the growth, the biotechs, the ARC funds, tons of options activity in these things. And so it's really important to watch that, because, you know, if you're a call holder and the call goes wildly against you, you're more likely to sell it. And the price action in the underlying is magnified. So when you have a week like you've had in ARC last week, you know, pretty much everyone that was in calls that weren't extremely deep in the money was either wiped out or sold out. And so that also exaggerates some of these moves, because, you know, if you look at the ARC put call ratio, there's almost always a lot more calls and puts. And so you've always got this sort of vulnerability of bullish positioning kind of working against the bulls in the way that options are going to work when the calls are starting to decay from theta. Market makers can take off hedges if they were so inclined to do those hedges. And then you've also got just the technical vulnerability. This is with ARC K and ARCG, these are things that are making new 52-week lows. Today was a little bit of a reversal, but, for folks that are out there, the reason I'm saying all this is if you're trying to catch the falling knife here, please be careful. A lot of people have been destroyed. If you're using leverage and you can't sleep at night, downsize your positions. You don't need to be a hero. Wait for institutions to buy. Show that there's a technical reversal. Show that there's a regime change at the macro level that supports the sort of longer end of the speculative spectrum of risk, and you're less likely to get burned. We're in a market regime right now where we can very clearly see that institutional flows are going away from biotechs, away from technology, away from growth, into value factor, into energy, into finance, and those flows are enormous. I mean, we had something like 10 to 11% returns last week in like the regional banking ETF and the oil and gas ETF. These are like returns that happen over the course of a year sometimes. They happened in a week, and they happened with a lot of volume.
Well, an interesting thing was, so last week alone was the biggest selling of all time in 1 week out of hedge funds, out of technology stocks.
Yeah.
I mean, but here's the thing though. So I'm not blowing my own trumpet, but, and a lot of us self-like me in this space, buying energy stocks, oil, $20-$30. I know Madavi bought it minus 36. But, and on all those stocks that go with it. So the people that are buying energy stocks are the ones that were buying this crap up here and dumping it down here. So keep that in mind. So
that's a good point.
I mean, I actually, as Alex said, sometimes I can't even get on Twitter because it just infuriates me, right? Because I'm seeing the same bloke I know that was telling people to buy, well, this is ARK I got up now. They're telling you to buy it here, and they look like a legend here, right? Oh, I told you to buy it, right?
Hey, mate, it's infuriating when you get gas at negative 37 and they don't do blurt for you.
They don't what?
They don't bring you the gas. You remember I called them?
That was oil, yeah. Well, you wanted to put it in your back pool. I said, I don't think they allow that. If you're in Texas, you could have done it, but you're in California.
The guy looked at me like, huh? They don't do that.
I'm just joking. You got to be registered
imagine?
beforehand.
Did you guys imagine that if Madavi had a pool full of crude oil in his backyard? How hilarious that would
Well,
be!
I give you the tip. It wouldn't surprise me. But but the thing is on what we're saying, right? Is so if we go back to oil itself, and we're treating. Madavi gets always excited when I show WTI, so I'll try and show it without him getting excited. Where's the daily chart?
I could have filled up in Vegas, all the 3 pools.
I know. Now you're showing off. But so here's a good example. So no one wanted to buy oil for whatever reason because they didn't want to be at a cocktail party. I know, and this is true. I know a lot of New Yorker friends. Well, I won't call friends. People I know, they would refuse to say they ever owned oil and gas. They loved saying it when it was 100. The whole, you can't buy fossil fuels. A lot of these people started to buy in again because greed overtook who they could talk to, I guess. It didn't matter anymore. So they're buying up here, 80. This is $80, right? Up the top here. Then we have our illustrious president sell all our SPR. The good news is they sold it to Exxon right around here, right? They were the biggest buyer of it. Here we are. So bought, sold, a lot of them. You remember, this is when we went through we got to shut down pipelines again. That's still going on with our energy secretary. I can't remember her name. So all through here, from about here all the way up, this is $50. And natural gas, if we were to show that, did the same thing, right? This is $6, about here somewhere. Anyway, they're making beaucoup money. So these oil companies weren't going up with them. So that's why they became really good value. Now, if I was to put in, and we'll do that in a sec, the XLF, no, that's Banks. Which is the one I'm trying to think of? XLE, sorry. So that's going to be way up here. But it's just catching up to these profits. But the trouble is you want to buy them on pullbacks. You want to get your good technical setup. The point I'm trying to make is the same guy that was selling down here is buying up here. Every chart,
Right.
That's why I never I've done the mistake giving money to money managers,
That's another thing that's important to talk about because, if you don't if you're watching this video right now and you're not a trader, maybe you're an investor and you're just nervous about what's going on in the markets, or maybe you're just getting your feet wet in trading, but you also have a long-term portfolio and you don't know how to manage it. There's no shame in just using passive index funds if you don't want to manage all this. Very few active managers can beat the S&P 500.
Yeah, you're talking about passive as in S&P, QQQ, right?
Yeah.
Not ARKG
and mostly
that sort of stuff.
Those are actively managed, high beta risk that I don't advise anyone to take on unless you understood.
Right.
Yeah, you got to understand exactly what you're getting into. For the average person, it's not suitable. But for the average person who's like, this is too much, I don't understand it, and they want to have some kind of exposure to the market, something like the Vanguard S&P 500 ETF, which has the lowest fees of any S&P ETF, it's very liquid. That's probably a better choice because, why not just get exposure to the market passively, not have to pay a money manager who's going to charge you a higher fee and probably make a lower return, which is kind of ironic. You've got the Vanguard S&P 500 ETF symbol VOO. Anyone can get exposure to that and use that as a mechanism to have some U.S. exposure, also because I think it's 45% of S&P 500 revenues are from overseas. You get overseas exposure by virtue of that.
Yeah, because
too.
there's been so many takeovers from overseas of the American companies,
and we're international too, right? We're selling a lot abroad. We've got business coming. So everyone listening, the market is not a place where you have to be buying and selling and trading every day if you don't want to. If you do, that's great. You're in the right place. Madavi and Andrew and Johnny and me, we're talking trading all the time. And when Nick's here, we're talking it too. And this is something we're passionate about. But if you're just listening to this and you're more concerned about your long-term investments, and you're concerned about the volatility in the here and now, there's no reason to change anything. Keep on the strategy of passive investing. If you're doing it, if you're dollar cost averaging, there's no reason not to stop dollar cost averaging. You're just getting more for your money right now, essentially, with the market drawing down a little bit.
Well, the thing is, it's not really down that much. right?
Right. But I guess my point is, like, a lot of people get very nervous at the smallest moves because we've had this regime of like 3 to 5% moves being like, quote, big, unquote, because a lot of people never experienced a real stock market. We've just had a liquidity bubble. Like one of the easiest markets to make money in really ever, especially, the back half of 2020. And I'm saying a lot of people think, oh, we go down 3-5%, it's the end of the world. Actually, most of the time, that's just the beginning of a downward move. In a normal market, you can get 5-10% correction at a 200-day moving average test, no big deal. So don't freak out. Like if you log into your portfolio and you're in safe funds, if you're in things like the VOO or other passive funds that are diversified, and it moves a lot because the market's getting choppy, don't make a decision just based on emotion. Is your investment thesis still intact? Are you still dollar cost averaging for the long term? Nothing to change. But if you're trading and your position goes against you, or you're investing and you're not in something stable and diversified and your position goes against you, it's time to start managing that risk and understanding, did your thesis go against you? Is your risk too high? And are you behaving with emotion or logic to try to manage that outcome? Sometimes things will come back, but often they won't. And when they don't, the opportunity cost that you pay by not pivoting can be pretty high. How are you going to make the money back if you aren't going into a more promising trade or investment? So just thought, to put out there, because I know a lot of people are concerned about what's going on in the market right now. It doesn't, in my opinion, seem like we're headed towards any kind of crash. We still have plenty of bid in high beta large caps like financials, energy, materials, industrials. We're not seeing this thirst for defensives. There's not a big bid in bonds or gold or utilities or consumer staples. So it doesn't seem like the market has that kind of pronounced fear. So if anything, it's just time to sometimes, continue down the path we're on as investors and as traders, be cognizant of higher volatility regimes and what that might mean for timeframes and position sizing.
Well, here's the funny thing is, this is the first time ever in the stock market we've gone like almost 2 years without having like a 10% correction.
Exactly.
It hasn't gone down in a long time.
Well, I think everyone should do themselves a favour. I banned CNBC back in 2007.
Yeah.
So look, if you want to go to the racetrack, go to the racetrack. And guess what? You put $10 on this, $10 on it, have fun, have a few beers, whatever you want to do, right? But that's listening to stations like that. I mean, Madova made a comment yesterday or today. The same, they just wheel on the most bearish people on the bearish days, the most bullish because they want excitement, kind of like clickbait. But so if any of these, so people should have been telling people to sell these things 6 months ago, all this tech crap, buy the dip crap. And they're all a hero all of a sudden, but that's what's on these TV stations. So be very mindful. And then we're all human. And now in a partisan world, people tend to listen to people more than what they should. And COVID creates all this other stuff. That's all real. So you want to be in an environment where you're mentally sound and not challenged by that sort of thing. That'll affect you because how many times do we say, oh, did you buy this stock? Did you buy this? Oh, why is it down half? Or whatever.
You got to remind them, because they're on TV, doesn't make them they're the smartest people around.
Well, I would go the other way, right?
There's a reason why they're on TV.
Exactly.
That's a really good point, actually. We should take a moment to touch on that. If someone's on TV telling you how to trade and not actually living on their own private island with all their great trading ideas, then that's why they're on TV, because they couldn't. Right? Like if they were so darn good, if they were the next, Paul Tudor Jones or whatever, they wouldn't be on TV telling you what to trade. They'd be, successfully running their own firm and killing it and loving it. And that's, that's one of those things. It's like, and it's not to disparage. I mean, obviously you get good guests. There are some good guests that go on, but the people that are on there every day in and day out, talking about this is the hot stock and this is what you should be selling. And
I get the impression they're paid to do it in some way or another.
No, I mean, I don't want to cast aspersions, but I think you're right. And quite frankly,
drum up business for their firms and stuff.
Yeah.
Well, they just want your money.
So guys, like at the end of the day, I think we can all agree that when, you're new to this game, you're going to be more impressionable, you're going to be more likely to make big mistakes. And so if any of us who have been at this for a while can, imbue one bit of knowledge on everyone, it's don't listen to other people when you're making your trading and investing decisions. Do it with your own research, quantify your own risk, know what that is before you get into the investment or trade so that you can be responsible for it and you can manage it. None of these people care about your financial future the way you do, so you have to manage it yourself.
Yeah, I mean, that's the same comment I think I said about politicians the other day. When you really think a politician gives a rat's about you, these guys are another level. And, and I saw some comments on Twitter or somewhere, or I don't know, somewhere, wherever I saw it. And, at first I thought it was bloody, no, that can't be right. But it was about Jim Cramer. And I don't want to sound aspersions on it because he's... But the comment was that it's like he's playing a character. And I started to think about it. I said, perhaps he is, because he's got to be all fired up and that's what people want. And yes, so some of his ideas work out really good, but some of them terrible. I mean, that's kind of it, right? It's a character selling it. And he's not a bad bloke. I know people that know him and all that for that side of it. But I started to think, you're right. Prove to me I'm wrong, Do you think I'm wrong on that?
He even said he was calling me.
I mean, look, like one of the things is this is a market that is not only driven by so much more participation on the option side, right? We see so much more trading in there. It's also much more participation from retail. You've got a lot of people in this market that have never traded, that don't understand investing. Maybe they had some good luck in crypto or some of the, some of the big stocks that ran up in 2020 and 2021. But a lot of these people are getting run over by this regime change. And if we can do anything for those people that are on the sort of receiving end of this lesson being taught by the market where they're paying this tuition, all we can do is ask to learn your lesson. Like, just because you get beaten down doesn't mean you can't get up. But if you're going to get back up again, you got to understand how you're going to fight and how you're going to survive. Because this is not the market that you might have cut your teeth in. This is completely different. You can't throw a dart at any stock and have it go up. You've got to be very, very exacting and tactical and opportunistic if you're going to be doing that kind of trading. And quite frankly, what I would recommend for people that are looking at getting into trading for the first time is look at the most liquid, broadly followed, well-analyzed instruments. There's really nothing better than the S&P 500, whether you're playing the SPY or VOO ETF, or whether you're playing the futures or options for those types of things. That's really the heart of the market. And you'll find more people out there that can educate you about how they've learned how it trades. There's more analysis of it from all different angles, fundamentally, macro, technically, than really any other instrument on earth. So it's a great place to start cutting your teeth. Another great place is to start learning how to trade bonds, because if you can learn how to trade bonds, which are typically less volatile than stocks, you can also learn how everything else interconnects with the credit markets. So, start small. Don't go into the highest beta equity and play the lotto 0 DTE and expect for great returns. Start with small positions, try to get consistent wins, cut losses rapidly, ride winners, and you know what? You can be wrong more than you're right as long as you cut your losers quickly and you ride your winners. You can still kill it. There's a lot of people that are batting 40 trading, but they're cutting their losers so quick and they're getting big winners, it doesn't matter. They're still compounding.
Well, yeah, as I've often said in the way I trade and kind of when I used to, teach or help people, when I had traders for me that the best analogy I could use was from sport, from football, is you got to get your defense right first, right? And then you'll let your attack flow. And so if your trade isn't working, you get out, which is what Alex is saying. If it's small, or even if it's not working, you small up. I don't mean do 1 million trades by the same token. But what I see more than anything is people let their losses run and take really small profits. Yeah. That's the most common thing I say. And another thing, anyone who's been around and traded, and hasn't had a big loss or a big drawdown or even blowing up, it's just not true, because we're all human, right? And it's a mental game, and you got to learn that you're not God. You're not learn, and Madavi mentioned that today. And you can be on a really good run, and then you start to forget that, and then you'll have a good whack. You forget your rules, right?
Around, mate. We don't want to say his name, but there's one around,
Huh?
There's a God around. We just don't want to.
but that's. I mean, so don't be discouraged in that, and don't look. And also, trading's not for everyone. You know. But you do, the thing that keeps you in it in some ways isn't just the lifestyle and all that's going to be sold to you, the island and the Lamborghini. Forget all that nonsense. Independence is more reality, but it is one of the most interesting places you'll be and where you'll test yourself mentally from that point of view.
I think that's one thing. I just want to add to that a little bit, mate, because I really think that's where, for me intellectually, it's always a challenge in a good way. There's always more to learn. There's thinking on the fly. You've got to be, adaptive. You've got to evolve. It's a very kind of Darwinian type of, reality. If you don't adapt and evolve, you're not going to last long as a trader or, on a longer time frame as an investor. And I think that is what makes it both so entertaining and so immersive, but also so challenging. And a lot of people get ground up by it because they don't think that they need to be dynamic. They think, I've learned this one thing, it's working, I'm going to keep doing this one thing. It's fine to keep doing one thing, but if there's anything true about the market, the only certainty you have in the market is it's going to change. And so you have to be aware of those regime changes. What's in favor? What's out of favor? Are we in a bull market? Are we in a bear market? What kind of character is there to the market? Is it a volatility compression market where there's just not a lot of it like this? Or is it a market where there's a lot more ups and downs and therefore a lot more trading opportunities that happen on big price swings? And these are things that as you go on in time as a trader, you get more used to. It's kind of like the seasons. You get winter, fall, spring, summer. You have that kind of personality change in the market, and you might not be able to set your calendar to it, but as a trader you can start to recognize it and adapt to it, and so that's the sort of thing that's happening right now in the market. Is we're getting later in this credit cycle. We see that at least the Federal Reserve is making noise about doing more in terms of tightening. And that's changing the character of the market too. It's changing where money's flowing to and out of, at least in the here and now. Now, all these things can change at any moment. The macro situation can change. The Fed can pivot, and they may, and so these things can also change, which is why it's important for us to be nimble and adaptive. Just because we think we nailed it, and maybe we did, doesn't mean it's going to stay in any way, shape, or form what we thought it was. The market, the economy, individual stocks are going to keep surprising us, to the upside and to the downside. Things are going to happen out of left field too. You can have a geopolitical event. You can have something that happens in another country that impacts us that we weren't watching. So there's always more going on than meets the eye. And if you like that sort of thing, if your mind is hungry and you want to keep satiating that appetite, there's nothing better than finance. There's nothing better than trading and investing, because you're going to keep growing that skill set, that knowledge base. There's like an endless beach of things to learn, and you're just one little grain of sand, in this market universe. So it's exciting. It can feel overwhelming at first, but when you really do get into it, there's few other areas in life that give you that amount of a challenge that's healthy, that keeps you going.
Mate, you got to get out. You got to get out more.
I wonder what was really helpful.
But in serious, it does. It is very much.
Hey, man.
Yeah.
Too bad they're not around no more. The trading floors that we started out in, those were perfect places for people to
Oh
learn.
yeah. They don't have that no more. Those trading rooms.
All gone. Those new technology.
That's true. Everyone's internal.
But if you traded, we traded in the room. I started out anyway. I think Nate was there trading before I was. But there was like 100 people there. And
I wasn't in that environment when I started. Yeah, but definitely.
Get your 2 weeks course and get on the floor, the trading floor, and about a week later they'll be blown up.
Yeah, kill or be killed sort of thing. Yeah. Well, so a lot of that was because these people just wanted you and me, you the trader, for them to make commissions and stuff like that. So it's evolved. One good thing about the all of the commission, like the war that happened with E-Trade and who's the other one? He didn't have like free commissions and all that, and then the Robin Hood sort of thing. Your cost is so much cheaper than what it was when we all started out, right?
But back then we had the spread. So when I first started trading, it was like $20 per trade. Then if you had Inca, it was like another $10. It could cost you $50 to $60 to get out of 1,000 shares of stock sometimes.
Yeah, and it's so yeah.
Basis. Yeah, so it was quite a thing. but I learned a lot, you know.
Well, a good point Alex is talking to, and the main thing what the whole trades community is really all about is the whole world all interreacts. And that means commodities, different countries, currencies, different stocks. And so what it means is you should understand how they react. It'll get you ahead of the move way before it happens. So it shouldn't surprise you. But you'll also find something that you'll suit your personality. Maybe stocks aren't your thing. Maybe you want oil. Maybe you want currencies. I don't know, bonds, whatever it may be. But you should find. I just believe you should always trade something liquid, something you can get in and out. I'm very much from the defensive side of things. And I think what was the one you just mentioned, Alex? There's the lotto one.
Just sort of like the 0 day, 0 days to expiration kind of option lottos. I mean, occasionally you're going to find
same day options can be really good if you know what you're doing.
Yeah.
But
that's
so
what I was going to say. It's like sometimes.
Yeah. Okay.
Sometimes you can find like a good opportunity there, but like to play
Don't
them
put
habitually
it all on red,
exactly, and
put
that's what we keep seeing people do. Yeah, exactly. Size accordingly.
Well, so don't forget the other thing. Like a lot of people are saying that options run the market. I think that's totally all one way, because what it's also done is a lot of people now become more. Part of it could be just the punt, but there's much more risk management, as in buying puts, so that also slow, and buying calls can slow the moves down. Look, in something that's like the ones we were just looking at, R, K, and G, it exaggerates. You actually get, so most markets have, ever since 2008, have a put skew. But what Alex was talking about earlier was a lot of these stocks become call skews. And they're the ones that the options overtook the market. So just think about that. People are, overpaying the spread, because the market maker's going, what the heck, right? So they widen the spread out. The investor, who might be the little guy, not necessarily a little guy, because a hedge fund knows they can move it, etc. So, but all of a sudden they're all one way, and then they bottom fish. I think that's what you're talking about. So they might buy a call in the money, then they average as if it was a stock, right? So then it gets top heavy, it all goes too much one way. And so that ilk tends to buy the put at the worst time, like today, say, when vol was really high, and then you get this move up, So horses for courses too. Like there's times on the way down, I know that I don't want to buy something because I'm still just the patterns. But I know also in this world, anything can happen. But if I limit buying a call, say, that's my loss right there. I'm not going to lose more. Or buying a put. But I'm not saying you just buy it willy-nilly. But know your risk is the bottom line, right?
Yeah, that's a really important point. That's really the core of all of it. I mean, I know it's not sexy. I know everyone wants to focus on those gains and flash those big percentages. And I know, when you're out there on social media, it's much more tempting to talk about all the winners. But the reality is that it all comes down to risk first and foremost, because you can't keep trading if you don't manage risk. You can have a couple trades blow you up if you're not managing your position sizing, the duration, your strategy. So it's so much more important. And, if you're managing your risk well and you quantify your reward secondarily, it's going to follow, and where it doesn't, you get out and you rinse and repeat in the next trade. So it's something that we can't stress enough. And for traders out there that don't know this stuff and they see this world on FinTwit and StockTwits and YouTube where people are just saying, oh, I made 600% today and 100% yesterday, the duration, that's cool. And if they're doing that, they're the best trader that's ever lived. They're better than Nancy Pelosi. But on the other side of it,
pretty good though.
She's a legend. I mean, we got to give it to her. And so is Kaplan and Rosengren and
call Pelosi. She'll teach you that trade.
I'm trying to get in her Discord. No one's getting me an invite to her Discord, though. I've been trying for a long time.
I've seen her trade. She does pretty well.
Well, hang on, it's her husband. Remember, don't start aspersions on Nancy. She's a really lady. Really looks after, wants the best for everyone.
Yeah. I mean, everything.
Always
A Trader of the Year. She
So
made
it's
Time
so
Magazine's
much-
cover last year. Trader of the Year. Totally earned it. But look, not to get political, because for me, I got plenty wrong with both parties. Let's just talk for a moment about how risk is the center of it all. Because really, if you don't manage it, you're not going to last. And if you do manage it, that's your staying power. You're not trading just to make money. You're primarily trading to survive for the next day, week, month, year. If you want to be doing this long term, you're going to be looking at that risk and you're going to be taking that risk. Like I just had, I talked to my friend Jason today. We were talking about trading, and what he was talking about with his particular trading style is with any trade, he doesn't want to lose more than 1% of his portfolio. Obviously, less is ideal, but that's the maximum size. And so what he does is he sizes his positions based on that risk threshold, which means like if he's trading something like Bitcoin that's much higher beta, he's not going into a large position size because he'll get stopped right out of a position pretty quickly with that loss tolerance. And so that's the same kind of a philosophy that we can adapt. Obviously, it doesn't need to be the same percentage, but it's the same idea of position sizing, quantifying risk, and knowing when it's time to get out. Because if you're willing to lose 1% on every trade, well, then you can bat, you can bat pretty badly for a little while, and you can still keep moving forward. As long as you get some good trades, you're going to keep growing your portfolio. On the other hand, if you get emotionally married to your position, you may be more inclined to hold it as it falls further and further, just kind of hoping it's going to go back up. Hope isn't an investment thesis. It's not a trade thesis, so it's not going to get you anywhere but bleeding your account out. So you got to recognize both the risk to your capital, but also the risk to your time, that opportunity cost.
Well, yeah, I mean, if you start getting... remember I said this whole game is mental. I 100% believe that. If you start getting weak mentally, that usually comes from being too stressful, i.e. over trading, not sleeping. I mean, every year I take a couple of weeks off and just go off the grid somewhere. And I recommend that, right? And I'll just you shouldn't do it. So there's that. But if you're married to something, a bad position, that will affect you. Because then you start to doubt yourself, or you think the market's wrong, or you get all... So... and you're going to be wrong. It's just the way it is. The market mightn't like what you like. But so you want to get that mind as strong as you can. And, or give it a chance at least.
Yes. Really good point.
Yeah, I mean, but I think we covered everything pretty good. Right now we got the, I'm just watching this S&P trade around the 60 moving average here. But so what I noticed today was there was more people looking to sell to get short again rather than buy the dip. So reverted. There was a little bit of the Tina going. The machines were using the Tina concept pretty clear to me. The mental aspect was a lot of people have had a lot of their theories blown out of the water because, and I must have said this non-stop to the point people thought I was stupid, that on that way up, I kept saying a lot of people think they're traders now because you can't lose money, right? If where's ARKG? That sums it up. ARK, right? Where's ARK? Where did we put that stock? So on this way up, you couldn't lose money, right? And that's all people knew. And there was a lot of those, and then all of a sudden this happened by the dip, and there's so many stocks like this. So in a way, as part of your trader's education or reality check, is you got to lose money, right? Or your ego will take over and you'll get greedy and natural, and you put more on and more on and more on, and then that happens, right?
Yeah.
And there's good stocks this happens to too. Apple's a quality stock. It went up too fast because of the whole $3 trillion thing. It stayed up there for about 10 minutes. But it's down. In reality, it's only down $10 from its high, right? All-time high. Pays a dividend, does this. But if you're loading up on it at 182 because you think it's going to 200, instead of buying it, this is an Apple, but you know what I mean. So it's all where you get in, position size, take some off the table. Don't fall in love with anything in the market. Fall in love with your wife, your dog, your kids, that sort of thing, right? Not in. I mean, I'm kind of a little bit different, I guess. I'm not a big fan of money, believe it or not, for the sake of it. And yeah. But in other words, use it for a purpose. But don't. What I'm trying to say is, I mean, Pelosi's a great example. I was talking to one of my bankers today, and she came up, right? Believe it or not, this is a guy that. How does and I just made the comment. She's what, 80 years old or something like that. I don't know. She's 70, 80, somewhere in there, I think. When's enough, right? And so think of that, when you're trading. That's what usually gets people in trouble, is that aspect. Use your money. That's why a lot of people say, if you have a good win, enjoy it. Buy a good steak or something or whatever. Get someone a present. Donate some money. Do charity. Whatever it is. That stops this thing. Because I guarantee you, Alex, the ARKG fans up here, they were loading up more and more. Guarantee you.
Yeah.
I mean, I can put this chart on 100 stocks and it'll be the same thing.
Yep. Yep, and there's a strong positive correlation with the price of the 10-year and 30-year bond, and a strong negative correlation with the same rates. And so for folks that are in this stuff, you don't even necessarily need to come up with any other reason than look at the way that the interest rate environment is changing the appetite for risk. Like that's really what it comes down to, just from a fundamental macro basis. If you're looking at interest rates rising, especially like on the 10, 20, and 30 year, you're looking at a lot of the stuff getting a haircut, because what was returnless risk is starting to become risk-free returns in some of these debt instruments. And some of the ones that are a little lower quality, there's some risk, but people are getting positive returns when adjusted for inflation if this kind of move continues. That creates optionality.
Are you talking about people buying junk bonds, and that's what you're saying?
Yeah. I mean, like, basically, we're getting closer to a point where real rates on a lot of instruments are going positive if they're not already. So we're getting to a point where, like, fixed incomes is no longer dead. There is an alternative, and that's taking some of that. Well, by the same
token, we're not even at zero for most things, right? So it takes a long time. So let's backtrack on rates a little bit. So the biggest thing is people got to follow someone. That's sheep, whatever, right? And I won't bring you up stories growing up on a farm, but what happens to the lambs. But basically, let's just say the 10-year. So 10-year is your most financing, etc. 2-year is your Fed funds, basically. So if we take just the very first day of this year, the very first day of this year, the 10-year note moved more than since 2009 against it, right? So yields up, bond down, if you want to think. So just think of that, people. And stocks that day, remember, they were record highs. So they weren't even, so the so-called experts weren't pointing that out. The big guys knew, hey, I need to get out of this. And then finally, 2 days later, they start talking about it, right? So then the market realizes, this must be something. They mightn't know why. And in reality, it's not really a big move. But the point is, when it moved, when that move on the Monday, they were still buying stocks when bonds were selling off for not good reasons. So let's take Jerome Powell. Jerome Powell said exactly the same bloody thing at his meeting 2 weeks before the minutes. The market reacted exactly the same way. The market chose to ignore it. Why? And people thought I was joking, moving up towards the end of the year to get their bonuses paid. People get caught up. As Alex said, don't worry about the greed. And I was saying about that with ARKG. Then it happened. So guess what? They got their print December 31, right? Last day of the year, remember? Friday. Monday, we got our 3 trill on Apple. And then all of a sudden, they worry about rates. And as, what's our boy's name? I can never remember his name. Kolonovich says, hey, this is exactly what happened in October last year. And it's exactly the mirror image. And look what it traded today. So keep all that in mind. So in other words, follow the interest rates, but follow them. Be proactive, not reactive. It's very important, and that's the difference on S&P. I mean, I know we're not in the bigger scheme of things. We're not a long way off the high. But if you're doing what Alex was saying on those options, just think of this: you're overpaying on the spread on the way up, and you're overselling on the way down. So your move that I'm saying is 100 handles is equivalent to about 400, right?
Yeah.
Very important. And I cut my teeth on bonds and currencies and stuff. And it's a different world. Everyone's hard. It's not this day trading where everyone's clicking and got a little chart. I mean, it's the best against the best. And like I said, they were doing that on the Monday when people are still buying stocks, right? Just look at it. And it's going to be on some of the things we would talked about it. But important to understand it. And with rates, it comes down to, at the end of the day, when they did moral hazard in 2008, and really they started with long-term capital, they don't lend when they're meant to lend. So they got any excuse not to lend. So it becomes a liquidity thing, you know. Anyway, I ran over.
No, you're good. That was great. I mean, I think that, we can cap it here. I think we had a lot of great conversation to share with the world, and hope that people of all backgrounds and skill levels enjoy what we're covering here, because we're going to keep talking about this stuff. 2022 likely to be a year of the trader, a year of stock picking, and a year of some people just putting it in passive index funds and walking away. But whatever the case may be, keep coming back. Traders Community has great content. Their website, traderscommunity.com, is regularly putting out excellent analysis, not just of the stock market, but commodities, bonds, foreign exchange, and other items of interest. So make sure you check that out and follow them at TradersCom on Twitter.
Thanks, mate. Appreciate it. And I just put this up because a lot of people, this is a good, so if you don't have, a lot of people just don't have access to the bond market or don't understand, because it can be, there are some kind of niches, whatever I'm trying to say. Niche, that's the word I'm looking for. But you can follow things like the tilt and stuff like this and give you an idea of how the market reacts. The same as if you want to follow volatility, follow VIX. You don't have to trade it. It's not a bad vehicle though, right, guys? But you'll see how it's reacting. And in other words, what I'm saying, you want to be the guy selling here, not selling here. And so I just think this year was the best example I've ever seen of total just ignorance by the people on TV, the people on... And Alex and I have been talking about this for a month or so. It wasn't as if... And it happened on Monday. It was like, I think I said, Jesus, am I just so out of touch? And lo and behold, on Tuesday, the rubber met the road, right? So be aware of that. And just because something goes up doesn't mean it's going to keep going up if it shouldn't go up, right? There's a saying in commodities, the rubber's always got to meet the road. And it does. It comes back. Balloons pop. I mean, and
yeah, believe it or not, price discovery still exists.
Right. I mean, so there's a reason when people make fun of these guys that don't invest, the really shrewd investors, and they wait for their time. They bide their time. Look at this ARKG. That's the.
You know what?
Which is ARKK, whatever. They're all the bloody same, but.
Let's quickly just touch on that for 1 second. That's the last thing I really want to talk about is the fact that, people that really are patient, and I'm not talking about being unrealistic in price expectations or unnecessarily cheap, but people who are patient and wait for the price of things to come to them, who find, hey, I've done my analysis. I understand that my valuation, if I'm getting into this thing with minimum downside risk is going to be here. And you wait for it and you get it if it happens. And if it doesn't, you move on to the next opportunity. That's a great way to invest. And 2022 is probably a market where there's going to be more of those opportunities than the last 2 years, except for maybe during the COVID correction. So, that's another thing to think about is like, you don't need to chase, the market can come to you. And often is the case that when you least think that the market's going to come to you, when you're most tempted, to buy into that rally because you think, oh, I'm fearing it. I'm fearing missing out on this. If I really don't get in here, it's just going to blast off to the moon or whatever. The reality, 99% of the time, is that's the closest before it's going to roll over and give you that chance to buy in at a better price.
Yeah, I mean, there's always another opportunity. Like, just
Yes.
That's life, right? You think when you're at college or high school and you missed out on that guy or girl or whatever, just think logic. Like, as silly as that sounds, that's life. You just move on. And believe me, you won't even remember that stock. We can all be Johnny Hindsight and say, if I only bought 1,000 Apple 20 years ago or whatever. But, I mean, never look back at the past for the negatives. Certainly don't forget losses and what went wrong. That's not what I mean. But don't dwell on the past, right? And I'm sure your mum and dad told you that. I mean, the reason I mentioned that about interest rates, people are kind of sheeple in more than what we think. So here's a good example. We all knew there's inflation. Everyone goes and shops. Everyone fills their car up with gas, right? Whatever it may be. We know new prices are going up. And at the end of the day, they really are transitory in the sense that this is a lot to do with supply and the ESG cause the oil and gas, all these things. That's not going to be there forever, but they're longer than what everyone hoped for or thought because there's so many unknowns. Look, we're nearly done with COVID. Omicron turns up. I mean, there's all these things. But an interesting thing I noticed today. So the New York Fed puts out their expectations and of what the consumer, not just them, Michigan University does it as well. So the Fed's saying they expect in about 6 months to inflation to come down to 2.5%. And I think a lot of us think the deflationary element's there, and that's certainly a possibility. The consumer, because of what he hears on TV, remember, he didn't care 2 months ago, even though he was paying those kind of rates, right? Now he thinks it's going to 5.7%. So you can see the way everyone's shaped in their perceptions and sentiment. And one thing about Bernanke that he had right was he believed the biggest thing that influenced an economy is a consumer confidence, consumer sentiment, and business sentiment. So keep an eye on that more than anything, because that's what moves the moods of markets. What makes a stock rip up that's not worth it? Because everyone wants it, right? Everyone's talking about it. Why were you buying Apple at 182 and not 158? Because everyone's talking about it. Just think of that logic. Why were everyone selling today at the open, not buying? Why was everyone buying at the close? That's unfortunately markets. That's human nature. So work out a way how to see through all that.
Absolutely. Well said, mate.
Well, thanks for popping in, Alex. And Alex is, as a new venture, as many of you, I think if you've seen on the website, what's the thing? Twitter.
Yeah.
So, and that's exciting. Trader Aid. If you just want to tell us a little bit about that with Horse. What's Horse's real name? Not real name. His real Twitter name. Michigan.
Yeah, Michigandolph. Twitter name.
And I forever thought that was Gandalf, as in that was your accent. Gandalf, as in Lord of the Rings, but it's actually Michigan and golf. So don't tell him that.
So we're starting this community called Trader Aid. And Trader Aid is, it's a subscription service. It's got courses and classes. It's got premium content, I should say, like information. One of the articles that I most recently wrote was about how to do full cycle investing, like how to identify where you are in the cycle, what's in favor, and how to identify, what may be stronger stocks within those sectors as well to potentially consider for swing trades and investments. And then another one I wrote was the carnage underneath the surface. This was a free article, so we do also publish non-premium content. And that was talking about the sort of carnage in tech and ARK funds and how we saw interest rates going up, real rates going up, and value starting to outperform, which usually coincides positively with rising interest rates. So, I think the goal and really what Horst and I are setting out to do, and we're continuing a project that he started back in the back half of 2021, is to try to give the average retail investor as much of an edge as they can have, because 90% of traders are more than likely going to stop trading within 6 months to a year. And a lot of that has to do with just trying to go at it alone, being stubborn and emotional, doing a lot of the things that we just talked about. How do you stop those habits? How do you get into good habits? What kind of systems can you put in place? And that's what we're trying to help with. And we're also, trying to get interviews from guests. I mean, I'd love to have each one of you on so that we can provide content to the community from people who are seasoned traders out there. I think the more that people can learn from people who are professionals and have been doing this for a while, the better that they can do in their own trading. And we're also, I'm going to be putting together my own course. Horst has a course on day trading he put together that's great. I'm going to be putting together kind of something similar to that, but more longer term, looking at identifying swings and investments and how to try to optimize for asymmetrical risk and reward. And then another thing that, we're trying to focus on more is just a lot of the places that are out there, and I'm not trying to cast any stones or anything like that, just to differentiate. A lot of places that are out there, their goal is really to try to just tell people, buy this stock at this time, sell this stock at this time, or short the stock here, cover it here. And that's great if that's all you want. But I think that it's best to try to equip people with the knowledge that they need so they can be self-sufficient, because, you're not going to have your teacher there forever. And you need to get to the point where, if you're really serious about doing this, that you understand what you're doing and why you're doing it, and can start identifying your own opportunities and become self-sufficient. So, for us, we don't expect that, maybe people won't hang around forever. Maybe that means they've actually succeeded, and that's a great thing. I mean, if people have used the material and gotten to the point where they're, making a living trading, or at least getting to the financial goals they wanted to by trading, then we've succeeded. So, we're really just there to try to help bridge those gaps. And there's a lot of great stuff out there on the internet, but there's also a lot of not so great stuff. So we're trying to also improve the signal to noise ratio. There's websites out there that are awesome, that are free, like traderscommunity.com too. So I always encourage everyone to check out what Andrew's working on, what other folks that are posting on there are working on, because they put out great content on the regular. And we're just trying to add to that and really try to put a venue out there that, caters to folks that are of all skill levels and backgrounds, that are trying to get more proficient and have the resources and the help they need to get there.
Yep, thanks for that. Well said. Yeah, and Alex has for a long time been working on that. So he's been real dedicated. Anyone that's followed like Markets of Mayhem or Mood Trade, if you remember that, is very big on trying to help the self-directed trader and sharing his own, or retail trader, as you say, to stand on their own 2 feet. And that's the important thing. Like, I could sit here and teach how to trade, what I do, and Nova Wave and all that. And I remember what W.D. Gann said, and some bloke was talking crap about him the other day. Remember that? I'm like, okay. But he said this. He said, I can teach any one of you how to trade, but 85% will fail because your ego will take over, or you won't learn, and anything like that. So take what you learn and really understand it. That's what Alex is saying there. Understand, instead of just blindly buying a stock because Freddie's buying it or Billy's buying it. Guess what? At some point, you're going to be Johnny or Sally or whatever holding the bag. So just understand whatever you're learning, and understand how it works. And if it works for you or it doesn't work, there'll be something that does, So that's an important thing to recognize, that you can do it yourself, but just do it in your own time, learn at your own pace. Sorry, that's what I was trying to say. But anyway, all good stuff, and it's been a long. It's 6:30 here, geez. So thanks for popping by again, Alex, and good luck with that, and good luck with everyone with the market. Tomorrow we'll see what Uncle Jerome's got to say. Is he? So I have one of my opinions, because I'm just a cynical bugger at sometimes, but I think a lot of the way they turned that up at the last Fed meeting was they knew, and it's no coincidence when all those minutes dropped, right, that tomorrow we have his hearing, and we have on Thursday Miss Leal, how do you say that, Leal, hearing. And so one of the big things, obviously we got, intellectual financial geniuses like Elizabeth Warren got certain views, but that's not what he's caring. On both sides of the party, there's two views. One, you should be expansionary. The other one is inflation, and I think he had to address that. At the end of the day, they want smooth hearings. It's important. It could well change once that meeting's over, whatever he says. But Mark, understand this. He knows all that work they've done goes to crap if everything collapses, right? There's no holding back because sentiment is their big thing. And jobs are their big thing. So if all of a sudden you don't have a job and they've got to sell their 401ks, just think along those lines. Maybe I'm too cynical, but they can't control what the market has as far as oil and gas alone concerns because they've killed production. They can't control what goes on in Taiwan with semiconductors or China shutting down cities. I mean, just think logically. So can they really control inflation?
Right. Exactly.
So, I mean, maybe I'm a little bit too anti-political, aren't I, at times, but there is a reason. But anyway, thanks again, everyone. Have a great evening, and we'll see what Jerome brings us tomorrow. Are we going to be smiling or crying this time tomorrow? Okay. Well, I got to go. Thanks again. Thanks, Madavi. Thanks, Johnny. Thanks, Alex. And
Thanks, mate.
Don't forget to like, subscribe.
Yeah, don't forget, like, subscribe, buy a T-shirt, buy a mug. Oh, we don't have them, do we? Ooh. So see ya. Bye now.
Buy a course. All right, I'll see you.
I've got to find this. We got too many things open here.